David Tepper is one of the most profitable investors in the history of Wall Street. From a college dorm room to working for Goldman Sachs, he built a fund that generated more than $30 billion in gains over 3 decades. He makes $7 billion in a single year, and $4 billion of it goes into his own pocket.
There is no one who has made more money more consistently by walking into a crisis and buying what everyone else is selling. No one. Not in my lifetime.
He survives 3 drawdowns of 25% or more and follows each one with triple-digit returns.
His edge was never information. Every trader had the same Bloomberg terminal. His edge was temperament.
David Tepper is the one man who turned the world's worst moments into the greatest fortune in hedge fund history. Pittsburgh in the late 1950s is a city that runs on fire. The steel mills along the Monongahela and the Allegheny burn around the clock, and the smoke settles over everything. The row houses, the church steeples, the laundry on the backyard lines. Stanton Heights sits on the East End, a lower middle-class neighborhood where families are one layoff away from trouble. David Allen Tepper is born on September 11, 1957, the second of 3 children. His mother, Roberta, teaches elementary school. His father, Harry, is a certified public accountant, a cold man who works constantly and comes home angry. Harry hits his children. The household runs on silence and fear.
His father was very abusive. You have to understand, this is a kid who retreated into his own head to survive. Even as a small child, his mind worked differently than the other kids on the block. He could do math before he could properly speak. His grandfather gave him baseball cards and he memorized every statistic on the back. His brother Scott remembered a boy who'd stare at a porch railing and think, if I put my head in there, would I get stuck? He wasn't playing, he was calculating.
At Peabody High School, Tepper never earns a single A, but he is already tracking his father's stock portfolio. He starts trading penny stocks before he can drive.
I got exposed to investment. My dad let me invest in a stock called Career Academies. I was really interested in how stocks move. It's like I really like collecting baseball cards and statistics and stuff. And then somehow I got the stocks and it's all kinds of numbers, and I love these numbers the way they played around.
One teacher tells him to roam the halls and act like the animal he is. The teacher is not entirely wrong. Tepper was a clown, but she has no idea what kind of animal this is or where it is headed. 1975. The Vietnam War is ending, and the American economy is in a recession. In Pittsburgh, the steel industry that built Stanton Heights is already showing cracks. David Tepper enrolls at the University of Pittsburgh, not because his family can afford it, but because he makes it affordable himself. He takes a job shelving art books at the Frick Fine Arts Library, working between classes to cover tuition. His father gives him 2 stock tips: Pennsylvania Engineering Company and Career Academies. Both go bankrupt.
That moment could have ended the whole story right there. Most people would have walked away. David didn't walk away. He studied why those picks failed. And that's really the first glimpse of the mind that would have later managed billions. He didn't react emotionally to the loss. He interrogated it.
Instead of swearing off markets, Tepper builds his own system. In his dorm room, he develops a method for trading options, exploiting small price spreads between contracts for steady, repeatable income. It is not glamorous. It is not a home run swing. It is a grind. Disciplined, mechanical, and profitable.
What was remarkable about the system wasn't its complexity. It was actually quite straightforward. What was remarkable was that a 20-year-old undergraduate built it himself, tested it with real money, and had the discipline to stick with it. Most college students who dabble in the market are gambling. Tepper was engineering.
He graduates with honors in 1978 with a degree in economics. And then he earns his MBA in 1982. He is 24 years old, with no connections, no family wealth, and a quantitative toolkit sharpened on the campuses of 2 Pittsburgh universities. Wall Street does not know his name. That is about to change. After Carnegie Mellon, Tepper spends 2 years in the Treasury Department of Republic Steel in Ohio. A year at Keystone Mutual Funds in Boston follows. His bosses call him one of the best credit analysts in the district. Then in April 1985, the phone rings. Goldman Sachs calls. He is 27 years old. Goldman Sachs is the most prestigious investment bank on Wall Street. It operates like a private club, hierarchical, political, and ruthlessly selective. Partnership is the ultimate prize, awarded to a handful of producers who also know how to navigate the culture. The culture rewards discretion, pedigree, and the ability to fall in line. David Tepper possesses none of these qualities. He arrives at 27 as a credit analyst on Goldman Sachs' brand new high-yield bond desk. Junk bonds are the Wild West of 1980s finance. Enormous profits, catastrophic risks, and a stigma that keeps most blue-chip firms at a distance. Goldman is late to the game and needs someone who can catch up fast.
Within 6 months, Tepper became head trader. The rise is almost unheard of. He is loud, profane, and relentlessly aggressive, but his results are impossible to argue with.
His edge was something that most traders on that floor simply did not have. He understood bankruptcy. He could look at a distressed company that everyone else had written off and calculate what the individual pieces were actually worth. The real estate, the inventory, the contracts. It was like being a mechanic who could price a total car for parts while everyone else just saw a wreck. That skill in the junk bond world was devastating.
By the late 1980s, Tepper is one of the most profitable traders at Goldman Sachs. He has made the firm millions. He has enemies in the hallways and admirers on the balance sheet, but he has not yet been tested by a true crisis. That is about to change. By the summer of 1987, Wall Street is drunk on its own success. The Dow has nearly tripled in 5 years. A new generation of traders is using computerized program trading to move enormous volumes at unprecedented speed. Money is flowing so fast that nobody stops to ask what happens when the machines start selling instead of buying. On the morning of October 19th, the selling starts.
Today is Black Monday, the day the Dow dropped more than 500 points, the day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929.
Across Wall Street, trading floors descend into chaos. Screens flash numbers that do not seem real. Secretaries are crying in the hallways. Senior partners at Goldman Sachs huddle behind closed doors in emergency meetings, trying to calculate whether the firm will survive the week. David Tepper, 30 years old, walks onto the floor and starts buying. While the rest of the desk is dumping positions at any price, Tepper moves in the opposite direction. He accumulates deeply discounted bonds in financial institutions crippled by the crash. Banks and brokerages whose debt is trading at a fraction of face value because the market assumes they are finished.
His logic was cold and structural. These weren't small community banks. They were large financial institutions with real assets, real deposit base, and real relationships with federal government. The market was pricing them for extinction. Tepper's thesis was that extinction was not going to happen. The government had too much at stake. So, he was essentially buying bonds at liquidation prices for companies that were not going to be liquidated. So the gap between the market sphere and the actual probability of failure was enormous, and that gap was his profit.
The panic passes. The bonds soar. Tepper is widely credited with playing a major role in Goldman Sachs' survival during the crash of 1987. He is 30 years old. He has just proven something to himself and to everyone watching. When the world sells, David Tepper buys. By the early 1990s, David Tepper becomes one of the most profitable traders at Goldman Sachs. But profit is not enough. Over the years, he is passed over for partner at least 3 times. His antagonist is John Corzine, the fixed income chief who controls the partnership ladder. Tepper has often bypassed Corzine's authority, going directly to Robert Rubin, the big boss of Goldman. In Goldman's hierarchy, these are unforgivable acts. December 1992. The final rejection lands. Tepper is 35 years old. He quits.
He wasn't fired. Goldman would have kept him. He was making them too much money. But Tepper couldn't stomach staying in a place that refused to recognize what he'd done.
Corzine killed me, so what I heard in that partnership thing. When I didn't get that partnership the third time, and I did everything. I mean, I put a lot of things together. I just, he was basically, that was the reason I didn't get it. He didn't like me for that reason. He thought I wasn't one of his people.
Tepper decides it is time to launch his own firm. He starts with nothing. No office, no fund, no investors. He borrows a desk from mutual fund manager Michael Price and trades with $3 million of his own money. Within a year, the $3 million becomes $7 million. Outside investors take notice. He raises $50 million more. In early 1993, he co-founds Appaloosa Management with former Goldman colleague Jack Walton, with starting capital of $57 million. With the money and everything in place, he just needs one big idea. And soon, he will find it. Algoma Steel sits in Sault Ste. Marie, Ontario, a single industry town built around a single steel mill. By the early 1990s, the company is bankrupt. Cheap foreign steel has crushed its margins. Debt has piled up faster than revenue. The creditors are circling. The stock is worthless. But David Tepper has a different idea. His thesis is the same framework he will use for the next 3 decades. The market is pricing Algoma Steel for total destruction. But total destruction is not what is happening. The company still has a functioning mill. It still has contracts. It still has a workforce and a physical plant worth real money. The Canadian government has a political incentive to keep the largest employer in Sault Ste. Marie alive. Bankruptcy does not mean death. It means the debt gets restructured and the assets get repriced.
What he did was buy the distressed debt, the bonds that Algoma couldn't pay, at a steep discount. He was paying pennies for claims on real assets. When the company emerged from bankruptcy, those bonds would convert into equity or get paid out at a recovery rate far above what he paid. The key insight was that the recovery value of the assets was dramatically higher than the price the market was putting on the debt.
Algoma Steel restructures. The debt recovers. In its first 6 months, Appaloosa Management returns 57.6%, an explosive debut from a fund that did not exist a year ago. Investors notice. Capital starts flowing in. Now he needs a stage large enough to match his conviction. A financial crisis is tearing through Asia like a wildfire. It starts in Thailand. The baht collapses in July after the government burns through its foreign reserves, trying to defend it.
Nobody wants to put their money when they see violence. So Thailand is right now fighting on 2 fronts. One of the fronts is that we have the internal conflicts, and the other problem is, of course, the financial crisis.
Within weeks, the contagion spreads. Indonesia, Malaysia, the Philippines. By autumn, it reaches South Korea, the 11th largest economy in the world. The Korean won loses half its value. Banks fail in sequence.
There was a crisis in Thailand in July. The Hong Kong stock market also fell in September. There was a lot of volatility. Taiwan went off its currency peg. And so investors started asking and wondering whether Korea had enough foreign exchange reserves to be able to manage this short-term borrowing if banks would stop lending to Korea, and that's what began to happen.
The International Monetary Fund rushes in with a $57 billion bailout package. The consensus on Wall Street is unanimous. Asia is radioactive. Stay away. David Tepper, now managing several $100 million out of Chatham, New Jersey, looks at the wreckage and sees an opportunity. His thesis is identical to every trade he has ever made. The market is pricing South Korea for destruction. But South Korea is not going to be destroyed. It is the world's largest shipbuilder, a major semiconductor producer, and a strategic American ally in East Asia. The International Monetary Fund is already on the ground. The restructuring is coming.
He bought Korean government bonds and won currency futures when both were trading at crisis-level discounts. His fund became the first non-Korean entity to purchase Korean treasuries. The logic was simple. Sovereign debt of a major industrial nation backed by an IMF bailout was not going to zero. He was buying government guarantee obligations at prices that implied the country would cease to exist. That disconnect was the trade.
South Korea's government asked the IMF for a $58 billion bailout, and the country wasted no time getting to work on paying it back. Millions donated precious family heirlooms to be melted into gold bars. The gold went some way to helping, even if largely psychologically, and thanks to economic restructuring and currency movements, South Korea bounced back, repaying its debt to the IMF in about 3 years.
Tepper bets on survival and wins. His confidence in his framework is absolute. But little does he know that confidence is about to cost him everything. In the late 1990s, Russia is a country running on fumes. The Soviet Union collapsed 7 years ago, and the economy never recovered. President Boris Yeltsin presides over a system held together by foreign loans and the price of oil.
Я убежден, что возрождение страны, ее экономики, рост благосостояния людей возможны только на пути укрепления рынка и демократии.
When oil drops below $11 a barrel in the summer of 1998, the last pillar gives way. Foreign investors begin pulling capital out of Russia at speed. The ruble is under siege. The government is burning through reserves trying to defend it.
Tonight, the Wild West of Moscow's new capitalism has met a violent end. For months, the Kremlin promised the ruble was a fortress. Today, that fortress crumbled.
David Tepper looks at Russia and sees another distressed debt play. A sovereign nation priced for extinction. An economy that the international community cannot afford to let collapse. The same thesis, the same framework, the same conviction that worked every time before. He loads up on Russian government bonds.
On paper, the logic was sound. Russia had nuclear weapons, a seat on the UN Security Council, and billions in IMF support. The Western world had every incentive to prevent a Russian default. Tepper was applying the same framework that had worked in Korea. Buy sovereign debt at crisis prices and wait for the restructuring. The problem was that Russia was not Korea. Korea had a functioning export economy and a political will to reform. Russia had neither.
The stock market had to be closed for the second time this week after it dropped more than 10% in an hour. It's lost 4/5 of its value this year. The banks are in trouble, the ruble faces a catastrophic devaluation, and interest rates have hit 140%.
The thing that was not supposed to happen, happens. The Palomino Fund, Appaloosa's offshore vehicle, plunges 49% between February and September. Tepper loses approximately $80 million.
That loss forced him to confront the limits of his own framework. He learned that government incentive alone isn't enough. You also need institutional capacity to execute a rescue. Russia didn't have it. That distinction between willingness and ability became a permanent part of his analysis from that point forward.
Just through life, I think it's how you bounce back from disappointment and failures. So I think, how you recover and how you move on.
But after the default, Tepper refuses to act irrationally despite huge losses on paper. He realizes now Russia is a perfect opportunity to buy in. He buys more, Russian bonds at 5 cents on the dollar, a nickel for every dollar of face value. In 2001, California's energy crisis pushes Pacific Gas and Electric and Edison International to the edge of bankruptcy. Rolling blackouts sweep the state.
Blackouts rocked California.
There's a number of investigations ongoing.
It's disgusting to see that the utility companies hadn't planned for it.
Tepper asks one question. Will California let the lights go out permanently? The answer is no. He buys millions of shares in both utilities in the low teens. The government intervenes. He sells in the mid-20s. Appaloosa returns 61% for the year. Then comes the trifecta. In 2002, Appaloosa loses 25% as the junk bond market collapses. 3 of the largest companies in American history file for bankruptcy in rapid succession: Enron, WorldCom, and Conseco. Executives are going to prison. Investors are fleeing.
Stock in the once mighty Enron Corporation, now heading into Chapter 11, closed today at 40 cents a share.
The SEC is now investigating Enron's accounting procedures after the company admitted it inflated earnings by more than $500 million and hit another $500 million in debt off its books.
Tepper walks in and buys the distressed debt of all three. Appaloosa returns 140% in 2003, the fund's best year ever. Tepper personally earns $500 million.
By this point, you could see the pattern clearly. Tepper wasn't predicting the future. He was exploiting a flaw in human psychology. When things go wrong, people panic, and the panic creates forced selling. Institutions dump assets not because the assets are worthless, but because their mandates won't let them hold distressed paper. That creates a gap between the market price and the actual recovery value. Tepper's entire career was built on living inside that gap. He was essentially a professional buyer of other people's fear.
By the mid-2000s, Appaloosa is managing over $5 billion. The track record is extraordinary, averaging 25 to 30% annualized returns since inception. The method has been tested against companies, utilities, sovereign nations, and the largest bankruptcies in corporate history. Every time, it works. Tepper's confidence has never been higher. The fund has never been larger. And the largest financial crisis since the Great Depression is about to land on his desk, along with the opportunity to make the greatest single trade in hedge fund history.
Lehman Brothers is going bankrupt. Employees of America's fourth largest investment bank saw the writing on the wall late Sunday after talks to pull them back from the abyss.
September 2008. Lehman Brothers files for bankruptcy, the largest in American history. The next day, the federal government seizes AIG with an $85 billion emergency loan.
Help is on the way for AIG. The government has agreed to provide an $85 billion emergency loan to help rescue the insurance giant. Bankers and federal officials decided a government bailout of American International Group was the best solution to keep it from collapsing.
Credit markets freeze. Banks refuse to lend to each other. Mortgage-backed securities, trillions of dollars worth, are revealed to be toxic.
That there are pools, there are mortgage bonds supported by pools of loans, and most of the loans are what are called negative amortizing interest-only loans, which means that you, the homeowner and buyer, you borrow the money, and you not only don't have to repay your principal, you don't even have to repay the interest. And if you just don't pay anything, they just add to your loan.
Within weeks, the crisis spreads to every corner of the global financial system. Governments around the world scramble to prevent a total collapse. This is not a recession. This is the financial system staring into the abyss.
Through a reorganization and further action, jobs will be saved, businesses will be made stable, and certainly our financial recovery will be easier, if not sooner.
Appaloosa loses 27% in 2008. It is Tepper's third major drawdown after Russia in '98, and the credit bust in 2002. Investors are shaken. The consensus on Wall Street is terrifying. The major banks will be nationalized. Citigroup is trading below $1. Bank of America is collapsing. The question is not whether the government takes over. It is how much shareholders lose when it does. In February 2009, Tepper reads the United States government's financial stability plan line by line. He models every scenario, and he reaches a conclusion almost no one else is willing to act on. His thesis is devastatingly simple. If the economy recovers on its own, bank stocks surge. If it does not recover, the government props the banks up. Either way, bank stocks go higher. Heads, I win. Tails, I win.
What made this so contrarian was that the entire market was pricing in nationalization, full government takeover, equity wiped to zero. Tepper was the only voice saying that wouldn't happen. His argument was structural. The government had more to lose for nationalizing the banks than from rescuing them. Nationalization would have destroyed confidence in the entire American financial system. The political cost was too high. The economic cost was unthinkable.
While the world sells, David Tepper buys. Bank of America, roughly 47 million shares at approximately $3. Some debt at 12 cents on the dollar. Citigroup, shares under $1, debt at 19 cents. AIG, nearly $2 billion in face value of commercial mortgage-backed securities at 9 to 10 cents on the dollar. Wachovia, Washington Mutual, Wells Fargo, Fifth Third Bancorp. He buys them all.
The mechanics were straightforward, but required extraordinary conviction. He was buying both equity and distressed debt in institutions that the market believed were insolvent. On the debt side, he was paying 9, 12, 19 cents for claims on assets that would recover at 60 or 70 cents if the bank survived. On the equity side, he was buying shares at prices that assumed permanent destruction. If he was wrong, the money was gone. But if he was right, the returns will be historic.
By the fourth quarter of 2009, Bank of America trades above $15. AIG paper bought at 10 cents sells at 61 cents, a return exceeding 500%. Citigroup debt purchased at 19 cents delivers a 220% gain.
The big three of the bailout era, Bank of America, Citigroup, and AIG, are posting gains that are catching even seasoned analysts off guard.
Appaloosa returns 132% for the year. It is, by nearly every measure, the greatest single-year performance in hedge fund history. After the 2009 trade, David Tepper is not just wealthy, he is one of the richest men in America. Forbes estimates his net worth north of $7 billion. He earns $4 billion in a single year. He is the highest paid hedge fund manager on the planet. In 2010, Tepper pays $43.5 million for an oceanfront estate in Sagaponack, New York. The property belongs to Joanne Corzine, the ex-wife of John Corzine, the Goldman Sachs executive who blocked Tepper's partnership nearly 2 decades earlier. Corzine loved that house. He received it in the divorce. Tepper demolishes it. He builds a new mansion in its place, 11,268 square feet, where 6,165 once stood. Nearly twice the size. When a journalist asks about it, Tepper's answer is 6 words long. You could say there was a little justice in the world.
That house tells you everything you need to know about David Tepper. He doesn't just win. He wants you to know he won. He wants the guy who rejected him to drive past and see a bigger building where his house used to be. That's not just wealth, that's a statement.
But by 2013, Tepper's wealth has given him something more dangerous than mansions and trophies. His words now move entire markets, and the consequences of that power are about to catch up with him. By 2013, David Tepper is no longer just an investor. He is a force of nature that moves markets with his voice alone. When David Tepper speaks, billions of dollars move. In September 2010, a single CNBC appearance triggers what Wall Street calls the Tepper rally.
This guy, no one has ever seen. Let me introduce our special guest for the next half hour. Raked in a record $7.5 billion for his fund last year by investing in financials, returning an eye-popping 132% for himself and investors. Joining us now in a rare exclusive interview.
The S&P surges nearly 2% that afternoon. In 2015, Tepper turns his attention to China. His thesis: Beijing is easing monetary policy to stimulate growth. A weaker yuan and cheap credit will lift Chinese equities and global energy demand. He loads up on energy positions: Cheniere Energy, Antero Resources, Energy Transfer Partners, Kinder Morgan, the Alerian MLPE ETF.
Certainly China is slowing, and the question is this a controlled glide, or is this the beginning of a free fall? The numbers are slowing, both GDP numbers and also import and export numbers. Also, consumption is up, investment is down.
Beijing is not easing. China's economy is decelerating faster than his models predict. Oil crashes below $30 a barrel. The energy positions he buys in the fourth quarter of 2015 drop another 29 to 30% almost immediately after purchase.
This wasn't a mechanical error. His process was the same as always. Read the policy signals, identify the mispricing, commit capital. The problem was that the policy signals were misleading. he read Beijing wrong. And unlike the Fed or the IMF, Beijing's decision-making was incredibly opaque.
The losses sting, but they do not break him. He replays every trade in his head. He dissects every mistake. He has said that replaying losses is the only way you learn from them. The legend has bled, but the legend is still standing. In the years that follow, David Tepper builds a second empire beyond Wall Street. In 2018, he purchases the Carolina Panthers for $2.275 billion, the highest price ever paid for an NFL franchise. All cash, no partners.
Carolina Panthers apparently have a new owner. Hedge fund manager David Tepper set to buy the NFL franchise for a record more than $2 billion.
He acquires Charlotte FC for a record $325 million expansion fee. He becomes one of the most powerful sports owners in America.
Charlotte's own David Tepper is ranking very highly among some of the richest sports team owners in the world. A recent report from Forbes puts the owner of the Panthers and Charlotte FC as the 8th richest sports team owner on earth.
The results on the field are less impressive. Through 6 seasons, the Panthers compile a record of roughly 31 wins and 67 losses, 7 head coaches, $70 million in buyouts.
Out there, we have a plan to, with personnel. We obviously have architectural plans for the stadium. So we've done a lot of planning. We've gone through personnel, and we have to, really now get really fast on the sporting side. That's what concerns me the most.
On New Year's Eve 2023, he throws the contents of a drink toward fans during a blowout loss. The NFL fines him $300,000. In May 2019, Tepper converts Appaloosa into a family office, returning outside capital to investors.
One of the most well-known hedge fund managers may close up shop. David Tepper has held discussions with LPs about converting to a family office at some point in time. It could be this year, it could be years from now, a timeline to return capital to investors and convert to a family office.
By 2025, the firm manages approximately $16.6 billion, roughly 90% belonging to Tepper and his employees. He is playing with his own money, the way he started. He turned Goldman Sachs' rejection into a $57 million fund that generated $30 billion in gains. He bought what the world was selling. He sold what the world was buying. He did it with a pair of brass testicles on his desk. And yes, this guy indeed has the balls.